Step 5, create a framework to decompose revenue drivers. We're almost to the 6th step. So what are you going to learn in this section? You're going to simplify revenue growth into price and quantity components. You're going to convert company revenue information into a structured framework. You're going to learn what to do when a company provides very little information. And you're going to see a series of examples showing how to construct a revenue forecast. On your cheat sheet, we're now at the 5th section down. So we use a structured framework to forecast revenue. Frameworks are powerful because they bring clarity and transparency. I can't tell you the number of spreadsheets people have shown me where it's just a mess. Frameworks make it easy to understand. They also help you decompose the business drivers, which makes forecasting easier. So let's look at Fastenal. Now, Fastenal already provides a detailed breakdown, and this makes our job very easy. In this breakdown, they're talking about their branch locations and on-site locations. So let's look at a branch. Here is a typical branch of Fastenal. You can see that it's got, a lot of stuff. It's actually got a lot of space. I'm kind of surprised, but you could call it a mini warehouse. That's a typical business. They have a branch. A company goes there, picks what they want, orders it, and then they'll come and pick it up, or Fastenal will deliver it to them. But now let's look at on-site. Here, Fastenal staff and inventory are located within the customer's facility. So you can see, number 1, the people are on site. Number 2, you can see the whole part of the factory where Fastenal is in control of the inventory. You can see number 3, where they back up a Fastenal truck every day and update the inventory. And you can see number 4, where the Fastenal staff is working on the computer side by side with the staff of that company. And then number 5, you can see the bins and all the different things that they use. So let's put it into a framework. So we have branches and on-site locations. So take a look at this table and tell me if you see any trends. Well, do you see any trends? And why do you think there are these various trends here? What do you think is going on? Well, first thing I want you to notice is I hate the way this table is arranged because it starts off in the year 2021 and then goes, it's almost like we read right to left, but I always read left to right. So I would prefer that it's 216 in the first column than 217. I find it harder to identify trends, but for some reason companies like to do this because they want you to see their most recent number first. Now, what you're going to notice on here is the branch locations are coming down, and the on-site locations are rising significantly. So the branch locations have gone from 25303 in 2016 down to 1793 in 2021. In other words, is this company shrinking? And you can also see the on-site locations going from 401 in 2016 up to 1416. In other words, they've added almost 1,000 on-site locations. So what's this all about? Well, let's talk about the on-site location. They say what your custom on-site program will include. And they go through a bunch of elements. So on-site solutions is like a one-stop solution for their customers. Fastenal can manage their supply chain and inventory, and this makes it very attractive for customers. I can tell you from my own experience with CoffeeWorks, it's a nightmare taking care of all these little inventory items that are not so easy to manage because you're ordering them from many different places. So management identified on-site as the number 1 growth driver and accelerates the investment. Let's read through what they say. On-site locations may influence the trend in our traditional branch count over time. It was largely a local option that grew slowly before we identified on-site as a growth driver in 2014. So the first on-site was 1992. They identified it as a growth driver in 2014. We have made substantial investments towards accelerating its traction in the marketplace since 2015. In many cases, we are shifting revenue from the customer with the customer from an existing branch location, though we are beginning to see more new customer opportunities arise as a result of our on-site capabilities. And then finally, they say we have identified over 15,000 manufacturing construction customer locations in the United States with potential to implement the on-site model. Now, they also mention in here that it's a lower gross margin, but it's a lower cost to serve. I would also argue that it's very sticky. If Fastenal can go into a factory and solve the inventory problem and get the inventory off the books of that company, I suspect that company will never kick Fastenal out. And they've identified 15,000 potential target clients. So management targets about 375 to 400 openings of on-site locations in 2022. And let's read the yellow section. It says, we also believe, as we follow our existing national account customers outside the United States, our market potential for on-site solutions will continue to expand. The international opportunity is substantial, but our speed is limited by the relatively underdeveloped infrastructure in comparison to the U.S. We expect revenues from on-site arrangements to increase meaningfully over time. So what's one constraint? Well, they're saying underdeveloped infrastructure. So next, it says, it is our intention to sign 375 to 400 new on-sites in 2022, though achieving this may require some relief in factors described above. Here we can see 2021, there was 1,416 on-site locations, which is 32% of revenue, and management thinks that they can add about 400 in 2022 and beyond. So there's a shift towards the on-site location, and it's been successful in the domestic market. We can see in North America, Fastenal closed 122 branches and opened 245 on-site locations in 2021. But what about that international expansion? In 2021, it only opened 12 new on-site locations outside of North America. Well, the question I want you to think about, is there an opportunity to expand Fastenal's business globally? And how much of a constraint to growth do you think is what management calls underdeveloped infrastructure? And how aggressively do you think that management would pursue global growth? Would you? What do you think? Think about this. Now, truth is, they have a tiny footprint. I made this table to try to understand what's going on, and we can see, let's forget about the US and Canada right now. We can see that they have 100 on-sites in Mexico and the Caribbean. They've got 15 on-sites in Central and South America, and they've got 17 on-sites in Asia, and they've got 22 on-sites in Europe. So this gives a picture of kind of where they're at. I would say that they're at the infancy stage, and the potential is huge. What do you think about the infrastructure issue? My perception of that is it's probably not as big as a problem as they think. Now let's talk about the price component. Luckily, Fastenal already provides us information about the price component. In this case, our price component is the average monthly sales in market locations and yield. So let's now go back to the annual report, and we can see average sales per branch location, average sales per on-site location to understand. And it says average sales per month considers the average active base of branches and on-sites, respectively, in the given year, factoring in the beginning and ending location count divided by total revenues attributable to our branch and on-site locations, further divided by 12 months, respectively. This information is presented in thousands. So we can now construct a pretty simple model here. This is a framework. We can look at the locations, which is branches and on-sites. And then we can look at the average monthly sales per location, which the company gives us both of these things. Now we know that from that we can say the revenue is that multiplied times the other. So locations times average sales per location. And the average locations at year ending and beginning. Then we have the times the average monthly sales, and then times 12 and divided by 1,000. and that gives us the annual revenue in US dollars million. So now, Fastenal also records some other revenue, which we can see in this line. And they say the portion of revenues generated outside of our traditional in-market location presence, but you can see it's not a big item. So this is a tiny item, so we don't need to break it down further. Instead, we can just apply a growth rate. Remember the story of my boss, Rob, who wanted to be first, and me, who wanted to be accurate? Think of that trade-off between speed and precision and also the cost of doing it. And when you do that, you can realize it's not worth it to spend time trying to figure out what that other revenue is. Learn to be efficient with your time. So now we have our framework, and we only need to forecast 5 lines to get our revenue. It's those two, the branches and the on-sites, and it's the sales per location, and then the other revenue. So creating the breakdown for Fastenal was not very difficult. The company provides a lot of details in their annual report and presentations, and Fastenal is very transparent about their business. But we will see in some other examples that this is not always the case for other companies. So let's think a little bit more. Why are some companies very transparent, but others hardly provide any information? So let's look at some reasons to be transparent. It's better ability to communicate the corporate message and objectives. Fastenal's decision to shift from branches to on-site locations is very clearly described in their information. Enhanced credibility and investor trust could lead to better awareness and liquidity. If the company did not provide all this information, think about it. We probably wouldn't be talking about it in the Valuation Masterclass. And as a result, you can see it raised awareness and measurable performance results that they can share with their investors. So what are some reasons to provide little information? Well, providing information is an additional reporting burden, and it's costly. If you start, you probably don't want to stop. So also, you might need to hire additional staff. A company might not want to disclose info which is relevant for competitors. And it might not bring any additional benefits. Apple or Microsoft provide only a minimum. Now, I want to talk about Brian Tracy in this particular book, Goals. He talked about how he went to a horse race, and the horse race was so close that they needed a camera to see who won the horse race. And he was amazed at how close they were. But what also surprised him was the winning money was something like $1 million for number one, whoever came in first. But for second place, it was 10 times less. It was 100,000. So if say that the prize money is 10 times more in the first spot than the second. So his point that he made is you don't have to be miles ahead of your competitor, just a little bit ahead. And what I've learned from my time as an analyst looking at companies for years is that many companies try to protect their strategy, but the truth is that getting your strategy out there and communicating doesn't mean that other companies are going to be able to beat it. It's hard to lay down a good strategy and execute it, and if you're executing it well, you don't have to be miles ahead of your competitor, and they may never ever catch up. So let's look at some of these companies. I'd like to start off with Ferrari. What's the revenue breakdown like at Ferrari? Well, here we can see that cars and spare parts account for 84%, and you can also see the pie chart that shows the destination. Sponsorship, commercial, and brand, well, that's a pretty small part. So really, if you think about it, I would focus on cars and spare parts, and I suspect that cars are the main part of that. So the most important segment is to forecast is cars, which makes up 84% of Ferrari's revenue. So let's think about price times quantity. In this case, number of cars sold is our quantity component, and the average sales price per car is our price component. Now, in Ferrari's annual report, you'll find a detailed overview of the number of cars sold and where they were sold. And we can then create a framework of where the cars are being sold. So there's 11,200 cars across the world, 5,500 are in EMEA, and also that's Europe, Middle East, and Africa. And then we have China and Asia Pacific for 2.8, and America's at 2.8 or 2,800. In this case, it makes sense to aggregate regions because they usually operate under the same environment. We don't need to look at each country. And also from the historical data, we can see that Ferrari increased its sales in Europe, Middle East, and Africa. So let's now think about the selling price for the car. How much does a Ferrari cost? I never bought one, so I really don't know. So remember, we're going back to price times quantity. We now have our quantity. So we have the revenue number and the quantity. To get the average price, we simply calculate revenue divided by quantity. And here we can see, you can notice that Ferrari was able to increase its selling price from $289,000 to $311,000 to $320,000 over the years. And once we've got that, then the remaining segments only make up 16% of revenues. So we're not going to focus too much on that, maybe just apply a growth rate. From the company material, we cannot get a detailed breakdown about these other segments. They just don't provide it. However, at this point, it probably doesn't matter that much as the segment's not huge. So my question to you, if you look at this, is Ferrari's main driver increasing quantity or price? That's the challenge. Is Ferrari's main driver increasing quantity or price? We can see this chart where they show the units and try to understand what's going on. And it says, compared to its competitors, Ferrari's car deliveries have been consistent and less volatile. The reason is that Ferrari generally faces excessive demand for its products, and customers have to wait several months or years for delivery. Now, there's intended scarcity keeps this brand desirable. From the 2021 annual report, they say, we seek to increase the average price point of our range and special series models over time by continually improving performance, technology, and other features, as well as by leveraging the exclusivity of certain model offerings and the scarcity value resulting from our low volume strategy. In Ferrari's case, increasing the price helps increasing the demand and value. Now, this gives you an initial idea about the underlying trends. However, there's much more to analyze, like production capacity, utilization rate, inventory, economic conditions, inflation, and many others.
Like, when I came to boot camp, I learned how to really use how to forecast, and mostly that relates to the numbers. But I did not really think much of the story that leads to that numbers. So I think I had it's like an overlook from my side. So I thought, it's not like you're just putting numbers in or you're trying to calculate something, but like there is a reason to that number, and what is the logic to that, and what's sort of like, how did that number come in the first place, and like what is the key story, and like how you sort of establish your story. And I think sort of the soft skills part of the boot camp, I think that's what surprised me the